Hello, my name is Nicholas Vardy, and welcome to my presentation, How to Invest Like Harvard. We're going to be covering a couple different things in today's presentation. We're going to start off with why Harvard's investment strategy matters to you. What is Harvard's investment strategy anyway? How can you implement Harvard's investment strategy in your own investment portfolio? And finally, why not investing this way could literally cost you millions of dollars over your investment lifetime. So why does Harvard investment strategy matter to you? Well, your portfolio of U.S. stocks and bonds probably made you no money over the past decade. That's in stark contrast to what the top university endowments did. Between 1983 through 2004, the Harvard endowment actually returned about 16% per year. Yale returned about 17.4% and Stanford 15.1% in the decade through 2007. Well, why is this? Well, clearly the top U.S. university endowments, Harvard, Yale, and Stanford, the three largest ones, pursued investment strategies that are vastly different from that of the mainstream investment community. And Wall Street and traditional money managers, mutual fund managers, and brokers have every reason not to advise you to pursue this investment strategy because it's not a product-driven strategy and it's not one that's going to make the money. So let's talk about what happened in 2008. All three of the endowments, top three endowments, actually made money through the year ending June 2008. Harvard was up about 8.6%, Stanford was up about 6.2%, Yale was up about 4.5%. Over that same 12-month period, the S&P declined 15%. The endowments did suffer a large downturn between September 2008 and March of 2009. Harvard lost about 22%, or about $8.1 billion. Yale was down about 28%, Stanford was down about 25%. That said, even including that downturn, over the 10 years through 2009, Yale was up 11.7% annually, and that result actually beat the #1 U.S. investment manager of the decade. So it shows you that the strategy is very effective, even including the massive downturn of 2008. Now compare Yale's achievements or returns to a traditional 60-40 portfolio of stocks. Those returned about 2.1% per year, and if Yale would have invested in that 60-40 portfolio, it would have returned only about $4.4 billion, or its endowment would be only $4.4 billion versus the $16 billion that it actually had at the end of 2009. So what's the secret to this impressive investment strategy? Well, the secret is extreme diversification, or what they call unconventional asset allocation. 20 years ago, 80% of endowments were purely in U.S. stocks and bonds. Today, Harvard, Stanford, and Yale only have about 12 to 15% in U.S. stocks. The typical pension fund today has 60% U.S. stocks, 35% in bonds, 5% in global stocks. That contrasts sharply with what you find in the portfolios of the top U.S. endowments. These include everything from fixed income to emerging markets to real estate, commodities, hedge funds, venture capital, private equity, and even a big allocation to timber. I pulled this chart up from the Harvard Management Company's website from a couple years ago. It's a nice pie chart which gives you an indication of just how diversified Harvard's endowment actually is. It looks like a pizza with no slice being really more than about 13 or 14% of the whole amount. You see allocations to domestic equities, foreign equities, private equities, commodities, real estate, emerging markets, high-yield bonds, absolute return, which is another word for hedge funds. You really see how remarkably diversified this portfolio is. And in this next chart, you see how that investment philosophy has evolved over the years. Back in 1980, 65% of Harvard's endowment was in domestic equities, in U.S. equities, and the remainder of it was in fixed income instruments, basically U.S. bonds. Now you see how through the end of the 80s that gradually began to change. And so by 2008, you see that the amount of U.S. stocks actually shrunk down to its current level, about 12 or 13%. Meanwhile, real assets increased, allocations to absolute return, private equity increased substantially. Allocations to kind of standard U.S. bonds and fixed income instruments also shrunk considerably. And so you have a much more diversified portfolio, and this correlates highly with the improvement in Harvard's returns over the next 30 years. Now, Yale's David Swensen, who's actually the father of this endowment model, argues that you really can't replicate the endowment's investment success. He says that you need a staff of 25 to 30 investment professionals, that allocations to hedge funds or private equity are basically impossible for you as an individual investor. He also says that top endowments have an edge of access to the top players, the top investment managers in the world. In fact, Muhammad Al-Aryan, the former head of Harvard's endowment, said that asking you as an individual investor to compete with Harvard's return would be like advising his son or daughter to drop out of school and play basketball with the goal of becoming the next Michael Jordan. Now, whether you agree with this or not, there are lessons to be drawn from the endowment investment model. You really should be much more diversified than traditional models that financial planners, personal financial planners would suggest to you. Back in 2005, David Swensen of Yale wrote a book where he recommended constructing a diversified portfolio which consisted of low-cost index funds to try to replicate Yale's strategy. Actually, things have changed quite a bit since 2005 because today there are a vast array of new index funds, or particularly exchange-traded funds, which really allow you to mimic this endowment investment model or Harvard strategy much better than when David Swensen wrote that book in 2005. In fact, there have been studies done that investing across a wide range of asset classes using exchange-traded funds in these various asset classes have a 90% correlation to the returns of Harvard's endowment. And you can really achieve those with little cost and no effort today. So what can you learn from Harvard? Well, I think it's very valuable to learn to think of your retirement portfolio as your own endowment. And understand that not following a diversified approach to investment like Harvard and the other top endowments really can literally cost you millions over your investment lifetime. You should learn that diversifying away from standard U.S. stocks and bond portfolios and other asset classes into other asset classes such as global stocks, commodities, real estate is really the key to your long-term investment success. And you should also know that your broker is never going to recommend this because it's low turnover and it doesn't generate commissions. You're never going to have a Merrill Lynch broker call you and say, hey, invest in this endowment strategy because that's what's going to be best for your financial future. So let me tell you a little about Global Guru Capital's Ivy Plus investment program. Its mission is really to give you access to David Swensen's insights, the insights of the endowment investment model, so that you can outperform the world's top investors. The Ivy Plus investment program mimics the asset allocation strategies of the top use endowments through the use of about 15 plus ETFs, exchange-traded funds, and index funds. The Ivy Plus investment program can be tailored to your individual risk profiles through the use of marginal leverage. We do that for some clients on occasion. In terms of what the program has done in the couple of little over 2 years that it's been running, it was up about 29.06% in 2009 and up about 10.5% in 2010. Interestingly enough, over the 12 months between July 1st of 2009 and June 30th, 2010, the performance of the Ivy Plus investment program matched the performance of the Harvard endowment almost exactly. It was quite a remarkable achievement in the sense that of how closely they replicated it. So if you would like a copy of this presentation, send me an email at nvardy@globalgurucapital.com. You can sign up for the monthly performance reports of the Ivy Plus investment program and the other investment programs at Global Guru Capital for free at globalgurucapital.com. You can visit nickvardy.com, my blog, for regular updates on global investing and additional continual insights on the Ivy Plus program. And if you're interested in having putting your money to work in the Ivy Plus program, you can contact me at 1-800-910-6410 to set up a free 20-minute consultation to discuss how the Ivy Plus investment program can really help you generate Harvard-style returns.